Are you ready to take control of your financial future? If so, investing in stocks is a great way to do it. Investing in stocks can be intimidating if you don't understand the basics, but with a little knowledge and guidance, you can become an expert in no time. In this video, we'll be discussing the fundamentals of stocks, including understanding the stock market and how to choose the right stocks for you. With this knowledge, you'll be well on your way to taking charge of your financial future. What are stocks? If you're interested in investing your money and growing your wealth, understanding stocks is essential. Essentially, stocks represent ownership in a company. When you purchase a stock, you become a shareholder in that company. And your investment gives you the potential to earn money through dividends, profits distributed to shareholders, or capital gains, profits made by selling the stock at a higher price than you paid for it. Stocks can be bought and sold on a stock exchange, such as the New York Stock Exchange, NYSE, or NASDAQ. These exchanges facilitate trades between buyers and sellers, and stock prices fluctuate based on a number of factors, including the company's financial performance, market conditions, and investor sentiment. When choosing which stocks to invest in, it's important to do your research and consider a variety of factors, such as the company's financials, leadership team, industry trends, and competitive landscape. There are many resources available to help you make informed decisions, including financial news websites, investor forums, and brokerage firms. While investing in stocks can be a great way to grow your wealth over time, it's important to keep in mind that there are risks involved. The stock market can be volatile, and stock prices can fluctuate rapidly in response to external factors, such as global events, political instability, or economic downturns. Additionally, individual companies can experience financial hardships or even go bankrupt, which can lead to significant losses for investors. In the next section, we'll cover some tips for choosing the right stocks for your investment portfolio. How do I choose the right stocks for me? Investing in the stock market can be an exciting but daunting experience, especially if you are a beginner. With thousands of companies to choose from, it can be difficult to decide where to put your money. But with some research and careful consideration, you can choose the right stocks for your investment portfolio. Here are some factors to consider when choosing the right stocks. 1. Do your research. Before investing in any stock, it's essential to do your research on the company you are interested in. You can start by checking the company's financial statements and performance over the past few years. Look for consistent revenue and earnings growth, as well as a solid balance sheet. 2. Look at the industry. You should also consider the industry the company operates in. Is it a growing industry, or is it declining? Are there any potential disruptors that could negatively affect the industry's growth? You should also look at the competition and market share of the company within the industry. 3. Management team. The management team is also an important factor to consider. Look at the experience and track record of the CEO and other key executives. Do they have a history of making smart decisions and creating value for shareholders? Some investors prefer to invest in companies that pay dividends, which are regular payments to shareholders. Dividend-paying stocks can provide a steady source of income, which can be attractive for those seeking passive income. It's essential to diversify your portfolio by investing in different sectors and industries to reduce the risk of loss. You can also consider investing in index funds, which track the performance of an entire stock market index. In conclusion, choosing the right stocks for your investment portfolio requires research, analysis, and careful consideration. It's also important to have a long-term view and to diversify your portfolio to reduce the risk of loss. With these tips, you can invest in the stock market with confidence and start building your wealth. When should I buy stocks? This is a common question that many beginner investors ask themselves. The short answer is that there is no one-size-fits-all answer. The right time to buy stocks depends on various factors, such as the current market trends, your financial goals, and risk tolerance. However, here are some tips to help you make informed decisions. 1. Buy when the market is low. Buying stocks when the market is low can be a smart move, as it allows you to get them at a discount. However, it's crucial to understand that no one can time the market perfectly, and trying to do so can lead to losses. 2. Consider your financial goals. Before buying any stock, it's crucial to have clear financial goals in mind. Do you want to invest for short-term gains or long-term growth? Your goals should guide your investment decisions and help you determine the best time to buy. 3. Monitor the company's performance. Researching a company's financial health and market trends is crucial before buying its stocks. Monitor its quarterly earnings reports, dividend payouts, and any significant news or events that may impact its stock value. If the company is performing well and its stocks are undervalued, it may be a good time to buy. 4. Avoid buying during hype or panic. Don't let emotions guide your investment decisions. Buying stocks during hype or panic can lead to rash decisions and losses. Instead, take a long-term perspective and focus on buying quality stocks that align with your investment goals. In conclusion, there is no set rule for when to buy stocks, as it depends on various factors. However, understanding the market trends, having clear financial goals, monitoring a company's performance, and avoiding emotional decision-making can help you make informed decisions when buying stocks. Remember, investing is a long-term game, and patience and discipline are essential for success. How do I sell stocks? Selling stocks is the process of disposing of your investment in a company's shares. It can be done through a brokerage firm or online trading platform. Before selling stocks, it's important to consider why you are selling and what you hope to achieve. Here are the steps to follow when selling stocks. 1. Evaluate the market. Before selling stocks, check the current market conditions to ensure that you sell at the best possible price. 2. Determine your selling price. Decide the minimum price at which you are willing to sell your shares. 3. Place an order. Place an order to sell your shares through a brokerage firm or online trading platform. Ensure that you enter the correct number of shares and the selling price. 4. Confirm the sale. After placing an order, confirm the sale with your broker. You will receive a notification of the sale once it is completed. 5. Monitor your account. Check your account regularly to ensure that the sale has been completed and the funds have been credited to your account. Selling stocks can be an emotional decision, especially if you've made a considerable profit or loss. It's important to keep a level head and focus on your long-term investment goals. In conclusion, selling stocks can be a straightforward process if you follow these steps. Before selling stocks, make sure that you have evaluated the market conditions and have a clear strategy in place. If you're unsure about when to sell, seek advice from a financial advisor. Risks involved with investing in stocks. Here are some of the main risks associated with investing in stocks. 1. Market risk. The value of stocks can rise and fall rapidly due to changes in the overall market or economy. Factors such as interest rates, political events, and natural disasters can all affect the stock market. 2. Company-specific risk. Even if the market is doing well, individual stocks can still decline in value due to factors such as poor management, legal issues, or competitive pressures. 3. Volatility risk. Stocks can be very volatile, with prices fluctuating significantly in the short term. This can create opportunities for gains, but also increases the risk of losses if you buy and sell at the wrong times. 4. Liquidity risk. Some stocks may be harder to buy or sell quickly, particularly if they are smaller companies or have lower trading volumes. This can make it difficult to exit a position if you need to do so quickly. 5. Currency risk. If you invest in stocks denominated in a foreign currency, fluctuations in exchange rates can affect the value of your investments. It's important to be aware of these risks and to have a well-diversified portfolio that includes a range of different stocks and other asset classes. You should also consider your investment goals, risk tolerance, and time horizon before making any investment decisions. Thanks for watching, and if you enjoyed this video, be sure to give it a thumbs up and leave a comment below. If you want to learn more, be sure to subscribe to our channel for more informative and educational videos.